Well, brain research shows that people who use theory of mind the most make the best traders. Why? Because they're like actually focused on the real question. It's not, are the earnings of this company, does it create this sort of valuation at this stock price? That's a clue, but it's a clue to what? How other people are going to perceive, is this stock cheap or expensive? But it's just a clue. So we confuse the clue for the question.
All right. Thank you for tuning into the NAGOMI podcast today. I'm your host, Sean Obana, and today we have the privilege and honor to have Denise Shull joining with us today. She is an experienced trader, performance coach, founder of the Rethink Group, and author of Market Mind Games, which is the main topic of today, with her core message being that emotions aren't the enemy, they are the data. So before we can even look at a chart or a number, we're already feeling something. And these can come out of the forms of excitement, fear, hope. And Denise calls this emotional context, or EC for short. And it's like this invisible filter that shapes every market decision that we make. So instead of trying to suppress our emotions, trying to block out all of these emotions, she says that we can actually learn from them because they're an actual data point. So with that, thank you, and I hope you enjoy this podcast. Denise, your work begins with a challenge to the traditional view that emotions must be controlled or eliminated from decision-making. What do we lose when we try to suppress our emotions?
That's actually a good question, and no one ever puts it that way. I mean, we lose our sense of pattern recognition. Like, it doesn't matter whether it's a sense, a feeling, or emotion, and that includes intuition, which is unconscious pattern recognition. All that stuff happens like below your chin. It happens in your body. And if you try to suppress one piece of that, the most energized piece, the emotion, you lose contact with the other pieces. So the trick, well, we can get back to what the trick is, but like you can't really know that you have a sense of confidence, for example, about a prediction if you're trying to suppress everything that's happening to you in your physical body.
And in your story about Michael, I loved when you said the best thing to do after a big blow up in the market is to actually feel bad and to embrace that emotional mourning. What does Michael's story teach us about the relationship between our past, like his relationship with his father, and our present trading behavior?
Well, that's a big question. So what we know about human perception is everything is a prediction, and everything is a prediction based on everything we've ever learned. And a big piece of that is about us. Like, we're constantly predicting, are we going to be safe? Are we going to be okay? Is this good or bad for us? Now, we usually don't know it. I mean, we can usually fairly easily access, is this good or bad for us, if we try to, right? But everything that's ever happened to us, including like who we are in the world and how we should expect the world to treat us, is, for lack of a better term, mixed up in these predictions. So the market, you're looking at the market, and it's this like implacable authority figure. You can't do anything with it, right? It's going to do what it's going to do. So it's kind of like when you were a little kid, and your mom or dad was going to do what they were going to do, and you were going to do what they wanted you to do.
Right.
And you couldn't do anything about it.
Yeah.
So like, if you think back to like being a little kid, you develop these ideas about how you're supposed to react. Well, those ideas come to play when the market's not doing what you want it to do. And so like, if people, let's just say, had a really controlling, critical parent, like Michael does in my book, you have a sort of an innate need to rebel against that. You have it when you're a teenager, of course, but when you're older, you still have it because you want to set your own boundaries. Like, this is who I am in the world, and you can't make me. And when you're 40 and they can't make you, like, the market serves as like a symbol of that.
Mm.
And so people end up, particularly when they're under stress, predicting that something bad's going to happen, i.e., they're going to have to do what their mom or dad wanted, and they can't do anything about it.
I think that embracing your emotional mourning is kind of like understanding your emotions rather than setting them aside, and understanding your emotions and how they interact with the market and the market's movements actually makes you a better investor. So I'm curious, you talk a lot about how traders and humans alike have an over reliance on math, and that formulas don't work over time because we keep changing them to fit what's happening. And that numbers aren't a language, or a language, not a law. So I'm curious, what does it say about us that we equate math with rationality? Does quantifying something actually make us wiser?
Well, it depends on what you're talking about, the degree to which you're talking about it. So I'm going to take a step back. Like, the market is a human construction, right? Made up of humans making decisions. Now, granted, humans make decisions using, math. They've analyzed patterns. They've come up with algorithms to recognize patterns and make decisions for them. But it's still like humans behind the algorithms, right? Humans behind the decisions that have been made. Like, a common discretionary decision in a trading algorithm is implied volatility. How much do you expect this thing to move on an hourly basis or a daily basis? Because depending on how volatile it is, it has a different personality, right? And you should react to a certain size move differently. Just to illustrate that, I was once taking a group of quants out to dinner, and they talked about recalibrating their models like every day. And I'm like, well, that's like a discretionary trading with a robotic arm. But so the point is, like, if you could know how other players in the market are going to value, it doesn't matter, stock, future, options, oil, commodity, doesn't matter. If you know how they're going to value it tomorrow or next week or next month, that's the only thing anyone is trying to know. And the brain research shows that the more traders, investors use theory of mind, which is, I have a theory of your mind. Like, I can see your face right now, right? So I might be thinking, well, he might be thinking this is crazy. Like, I have some idea about what you're thinking as you're listening to me. That's theory of mind. Well, brain research shows that people who use theory of mind the most make the best traders. Why? Because they're like actually focused on the real question. It's not, are the earnings of this company, does it create this sort of valuation at this stock price? That's a clue, but it's a clue to what? How other people are going to perceive, is this stock cheap or expensive? But it's just a clue. So we confuse the clue for the question. Now, take someone like Jim Simon's Renaissance. Like, yes, they made all this money trading on patterns, but what had they done? They had taken every bit of market data that ever existed in the history of the world and analyzed it to prove patterns like stocks fill gaps. Things that I saw when I was trading long-short equity in Chicago. I just didn't think to use all the computing power in the world to prove the pattern existed. So there's a role for math, and it does help to measure things. Like, even with my traders, like, are they doing better or are they doing worse? People's perception of how they're doing tends to be skewed because it has this prediction from their past and their self-image. And when they actually see on paper, how many winning trades, how many losing trades, how much do they win, how much do they lose, it's usually different. So it's information, but it's not like, I don't know, it's not like the be all and end all. They're clues.
Right.
They're just clues. Like, any form of analysis is clue, but it's really a human game. I mean, you don't win a poker game by playing the hand. You win a poker game by imagining how other people are playing their hands vis-a-vis how you might play yours. So you have these numbers, this math in front of you, and then you have what are the human beings doing with the math in front of me? And you win by playing that aspect of the game, not by playing the cards in your hand. I mean, you can play the cards in your hand, right? But it won't make you a poker champion.
Right. And I love this because you talk about this specifically in the book. You said that the key to speculation is predicting people, not prices, and predicting when will others get it too. So how do shared emotions like collective fear, greed, hope actually move the markets? And is understanding sentiment a better predictor than any other quantitative model? Can we say that for sure, or is that
well, we
still
can't say anything for sure. We can't really say anything for absolute sure. I mean, nothing is like totally provable. But so, I have all kinds of clients in all kinds of hedge funds with all kinds of analytical methods, right? Mm-hmm. The best ones, the last thing they do, not necessarily before they put a position on, but before they decide to size up a position, is they analyze what the hedge fund world calls positioning. And positioning means, has everyone else already bought this? Is everyone short this? Like, who else is left to buy? Who's going to pay? I don't even know what like NVIDIA's trading at, but who's going to pay more and why are they going to pay more? Not my analyst model says it should be valued at this, and that valuation is stretched, so therefore it has to go down. There could be 100 reasons why people would still be willing to pay more than what the historical valuation is. So the reason people look at charts, same thing. I have very fundamental investors who hold positions for, I have one long only fund. They hold positions for 3 years. We still look at charts and talk about those lines on a chart basically give you a sense of how the aggregate, market participants are feeling. And you can predict what they're likely to feel. Like if something's trading at an all-time high, everyone who owns it's happy. Everyone who doesn't own it but meant to buy it is unhappy. Everyone who's short is really unhappy and has to buy. So there are no natural sellers. Mm-hmm. So selling something at all-time high makes no sense vis-a-vis you need other people to push the price lower. You always need other people, even if they're using algorithms, to push the price in your direction. You need other people for the trade, the investment to work. So thinking of it as the game it is, how is that person going to play their poker hand? Or how are all those people going to play the poker hand of tech stocks have just rolled over en masse? Like who's going to think it's a buying opportunity and who's going to think, okay, it's time to get out? That's the question you're really trying to answer. And I do have a lot of pros who answer it last. They come up with their opinion. Whatever. We should be long this, we should be short this for whatever reason. Supply, demand, for whatever reason, doesn't matter. And then they go, yeah, but where's everyone else positioned? And so therefore, who's likely to sell it after I do or buy it after I do? Theory of mind, what's been shown in brain research to be the thing that successful traders are actually doing.
And you talk a lot about the fear spectrum. I think I've never even thought of that. And I think you talk about positioning a little bit and how an investor is always on the spectrum of between fear of missing out and fear of losing, and how emotions are scary, but they can't hurt you. And it's all about perception. People don't know if this stock is going to go up or down. Can you describe a spectrum, how can investors locate themselves between this spectrum, between fear of missing out and fear of losing?
The first answer is be honest with themselves. I guess the first answer is cultivate self-awareness. So you have some idea what you're feeling at all. Because, there are plenty of people in the world who were trained as they were growing up to ignore their feelings. And so they have a hard time accessing them. And they're only in their head thinking about like the pros and cons, or the pluses and minuses, the mathematical arithmetic analysis. Like, so the first is like cultivate self-awareness. The second of all is be honest with yourself. The third is don't judge. Like, you actually want to know what you're really feeling. And then you want to go, I'm afraid of missing out. Okay, what happens if I miss out? Well, I don't make that money and my friend does, which is something I hear in the hedge funds all the time. Okay, then what? Like, is the feeling actually about what the market's doing and what you think the market will be doing? Or is the feeling about you? Well, I'm going to miss out and I'm not going to make the money. It's generally about you and not about the market. So as you cultivate self-awareness, you're willing to have the courage to be honest with yourself, like, and you don't judge it. Like, you're trying to sort out the data set of feelings. A visceral intelligence is what, like, a researcher might call it. Stuff that's in your body. Like, you just want to know, is this about the trade or is this about anything else? Because about anything else, it doesn't have anything to do with the trading decision. And like I say I just got off the phone with a young hedge fund client. It's been in the market maybe 5 years. And we talked literally about this. If one could make all their decisions based on their feelings about the market, and your feelings about the market are like the feeling you're left with after you do your analysis, whatever that is, technical, fundamental, whatever, voodoo, I don't care. Whatever it is, you're left with a feeling about the market. If you could make all your decisions based on your feeling about the market and none of them on what's going to happen to you, you would, over your lifetime, make way more money. Now, the brain's programmed to make decisions based on what's going to happen to you. So it's hard. And number two, if you're in the hedge fund business, for the most part, how much money you've made in December is how much money you're going to get paid. So come December, no one's going to be able to make decisions on the market, or almost no one. Right. Like, you want to get paid. You don't want to give a bunch of your back. You want to get paid. And that is relevant to what's going to happen to you and your family. And, so there are moments where it's just unrealistic to make the decision on the market, your feelings about the market. But I ask my clients to be really conscious. I'm going to make this decision. I'm not going to get into this trade. I'm going to size this trade small. I'm going to get out of this trade because I want to get paid. Okay. Just know it. Because like, inevitably, you will have missed out on something. Something will happen, and then you'll be upset about that. And then that will affect your next market decision. But if you're really clear, like, I did this for this personal reason, then the market's going to have a little less, like, provocative power over making you feel bad that you missed out, for example, where you started. If that makes sense. Am I making sense? Am I making any sense?
Yes, totally. I get that. But where it's hard is that it's hard for people to interpret or internalize this, where it's like, it's all about your emotions, and you don't really need to know about the numbers. Or you need to know about the numbers in terms of, financial ratios, all that stuff, to make sense of a company's profitability and all of that. But when it comes to trading and making money in the market, I think that when I talk to people and I say, you don't actually need to really just follow these frameworks or these algorithms and stuff to make money. That's not really how you make all the money. It's more, there's a lot more about your emotions. And you talk about how facts have no meaning without context. And you say that, you quoted Damasio and said, I feel, therefore I am. And you speak a little bit about this emotional context and why feelings come before perception and logic. Can you explain a little bit more about emotional context and how it relates to the market? Because I've had a tough time with people saying and not believing that emotions have anything to do at all with the markets, and saying that numbers is where it's at. You look at the ratios, you look at the numbers, and then from there, you make your decision. But that often doesn't work out, as you're saying.
Yeah, I mean, so first of all, I wrote my book in 2010 and 11. It was published in 2012. I quoted Damasio a lot because he wrote a book called Descartes' Error, referring to Descartes said, I think, therefore I am. And Damasio was showing it's I feel, therefore I am. Because he had all this research showing if you didn't have emotion, you can't make a decision. Because you have no sense of what's correct. Like one of the experiments they did was like which day to make a doctor's appointment. They did another one on what to buy out of a vending machine. Like if you walk up to a vending machine and you have no idea what sounds good or would taste good or the candy you like or whatever, you're not going to know what to buy. You have no prediction about what's going to be fun and feel good to eat. So you cannot decide. Like he showed people who are brain damaged in such a way that they don't have emotion. They couldn't decide what day to go to a doctor because they'd be like, well, there's these reasons to go on Tuesday and there's these reasons to go on Wednesday, but there's these reasons to go on Tuesday, but there's because they had no sense of what's going to get them what they want. Without that, you can't make a decision. That's essentially a fact. So anyone who wants to disagree with that, they just don't actually know the science. But now what we know is you are predicting, like before you're even given input, like the vending machine, you're walking across campus before you get inside where the machine is thinking, I want whatever, Oreos or whatever. Like you're predicting that like Oreos will taste good. Well, now we know everything's a prediction, and it's a prediction about, is this good or bad for me? Safe or not safe? Does it meet my goals? Does it help me get what I want or not help me get what I want? Or put me in a bad, does it help me get what I want or put me in a bad position? That's happened. Like if people are listening to this podcast, some people are going, oh my God, that woman's crazy. Like, she's wrong, like whatever. Why? Because they're afraid if I'm right, they have to change their worldview. They don't realize they're afraid if I'm right, they're going to have to change their worldview. But that's what's happening. Like I'm threatening them by giving you the science about this. That's the problem in politics, by the way. The reason we can't have any political conversation, everyone's so afraid if the other side's right, oh my gosh.
Right.
There's lots of middle ground, but everyone's doing all this predicting all the time and much more easily able to do because of whatever, Twitter and TikTok, et cetera, than we could do 20 years ago. So like these things are well understood in neuroeconomics. Everything is anticipatory affect. It's prediction of whether this is good or bad for me, whether I'm going to feel good or bad. So, like, the market's no different. Like, is this good or bad for me? Will I make money or lose money? Assuming everyone prefers to make money. Like, you're making that prediction. And it's and it's going to influence your, supposedly rational judgment. Like here's the thing. In behavioral finance, they will talk about how we are irrational because a loss hurts more, proportionally than a gain feels good.
Loss aversion, right?
That's not even a little irrational.
Mm-hmm.
Like a gain, you're better off. If it's $1, if it's $1 million, you're better off. A loss, you end up having to make twice as much back just to get to break even. Like, a loss is worse than a gain. You should feel worse. Like, and how more people don't see that, I don't know. But like a loss is worse. You have to make up ground as opposed to like, okay, I didn't make as much. I made some. Like, it doesn't get me the car. Whatever. Like, the loss is worse. It is actually worse. So of course we feel worse.
So do you think there's a science behind that? Behind why, even though it seems so obvious to you, and do you think there's a science behind why people don't look into their emotions, or they don't trust their emotions, or they don't think that their emotions are rational in that way?
Well, is there science behind it? Some people would say there is, but what it really is, it's like, we used to think the earth was flat, right? So you stand on the beach and you look out and the earth looks flat. And so you don't think to sail around it because you think you're going to sail off the edge because it looks flat. Well, then someone figured out it's probably not flat, sailed around and found all kinds of new things, right? Well, it looks like emotion is the problem. It looks like people get really upset about something and then they take some action that's destructive. That's often true. But the emotion itself never made or lost a dime or caused any other. It's just something some individual is experiencing physically. Mm-hmm. If they don't make a choice and do something, nothing bad happens. When I first started trading, I was in this office with 19 guys from the SIBO, and I'm reading all these trading psychology books saying, take the emotion out of it, control the emotion, have no emotion. And the guy in the office who was making the most money was jumping up and down all the damn time, screaming, yelling, cussing. His name was Steve. And I was be like, take the emotion out of it, control the emotion. 19 guys in here, Steve makes the most money. He's constantly, I was like, but I didn't even then, it wasn't until, I read Damasio to rewrite my master's thesis for Little Institute of Modern Psychoanalysis. I didn't read it to write a training psychology, anything. And he showed you have to have emotion to make a decision. And I was like, well, that changes everything. But then when you start to think about it, like people don't think of confidence as an emotion. Confidence is emotion. Like you feel that this will work out. Like you feel like you understand something and you're going to do this thing and it will work out the way you want. Or at least nothing bad will happen, right? Like you'll be fine. You're a good public speaker. You're like, okay, I can get up and speak in front of anybody. Like nothing bad is going to happen if you feel like you're a good public speaker, right? Or like I live in a ski town. Yeah, I can ski that hill there. I'm probably not going to fall. Like in a sport, confidence is a feeling. Like people don't think of it as they think it's in their head somehow. Yeah, it has a relationship to your past experience and what you know about a situation. They are interactive, they are reciprocal. But what the research actually, it shows you have to have emotion to make a decision. You can think of that as confidence, and you're always predicting whether something's going to be good or bad for you, meaning, am I going to feel good or bad in the future? And you can't. Now, you see all kinds of studies still all the time. People who think positively, get better results. And, there's a book called The Upside of Your Dark Side by Todd Kashdan, written in 2015, I think. He says you can get a lot of performance out of your positive emotions, confidence and optimism, but you want that last 20% of human performance, you got to leverage the so-called negative feelings. The so-called negative feelings have a piece of information, a useful piece of information. And when you can sort out what that is, it tends to help you. Like what? If something makes you feel bad, a losing trade, whatever. It's like, well, how did this happen? What could I have done differently? There are the most lessons in understanding like why you feel some way. As long as you remember that all of us are taking everything we learned as little kids and it's imputed into there. And what you want to do is go, okay, I learned that as a kid. I thought that way about myself as a kid, when my dad always told me my sister was smarter than me or whatever, because all that stuff happens to everybody. But like, that's about that. And what do I feel about this?
So say we know that emotions are the key to become, or understanding your emotions is the key to becoming a better investor. Why don't we do it? It seems like from what you're saying is that we're scared. We're scared to delve into who we actually are in our emotions and uncover our own emotions because there's something in there that we don't want to find. And maybe that's the truth. And maybe we're just masking the truth with all these numbers. What do you think about that? Because you talk a lot about, instead of using your intellect, quote unquote, to be good in the market or create alpha, it's feel what you feel and use your intellect to understand more of it. So I'm curious, why aren't we delving into our emotions in context of the market, even though we know all the psychology behind it?
Well, we don't. Everyone's been told their mind is flat, as if the earth is flat. And if they think that it's round, that their feelings and emotions matter, they're going to sail off the edge. That's what people think. And they're told that all the darn time because there's just this, worldwide misunderstanding that the emotion that drives the action is the problem with the action. Someone's enraged and they, hit someone or for God's sake, kill them. Like, it's not the rage, it's the choice that they acted it out. I'm always teaching people to sit with the feeling and analyze it before you choose an action. Yeah. Just learn to live with the feeling until you decide what you want to do about that feeling that will get you more of what you want.
I see. So it's self-awareness, right? You say that self-awareness is the ultimate risk management tool. So if most people are using their intellect to shut down their emotions, and you say that intellect should interpret emotion instead, what does that look like in practice? Is it literally just sitting down with your emotions? How does somebody go about doing that when there is no playbook, when there is no, this is what you should be doing, this is what you should be feeling? Because it's kind of all foggy, and that, like, there's no guideline and there's no,
Yeah, yeah.
you
Well, I
know.
keep trying to put some guidelines out there. But having said that, so like there's a million different ways to interact with the market. There's no one right way. Like I'm a long, short momentum, now I'm an investor. I don't really trade per se. I mean, I do sometimes
Right.
put something on that only lasts a few weeks, but in comparison to back when I was sitting next to, famous who are now famous traders trading intraday. But like the market makes sense to be in a momentum sort of way. It makes other people, it makes sense to in a, like always be hedged, always have an option structure. But I'm telling you, from having talked to, at this point, thousands of professional traders and investors and portfolio managers, like everybody likes certain markets better, by the way, stocks, commodities, whatever, like, bonds, gold, whatever. Like, and then like there's ways that it makes sense to you. So you got to find the one that makes sense to you first. And you have to use it. You don't want to switch from one to one. You have to one that resonates. Like that seems right. And then you have to learn to understand what you're feeling. So you use your intellect. I mean, you have to use an intellect to even understand what the market is, right? Like a 5-year-old's not generally going to be able to do it, or a 3-year-old, maybe a 5-year-old starts to be able to understand it. But like you use your analytical method, and then you go, what feeling is this leaving me with? And I have my clients build a spectrum of fear, like panic may be on one end and overconfidence may be on the other, so that they can do what's called emotion differentiation and granularity. So they can go, you know what? I am afraid of missing out. I'm afraid of being wrong in this particular way, which are two different things. And then they can go, how afraid versus how much is my unconscious pattern recognition, my intuition, my experience in the market telling me this set of circumstances, this context is going to play out this way. So what the research shows, if you can identify the feeling, the chances that you can act on the feeling that is about the market improve. And the chance that you don't act on the feeling that's about you, I'm going to miss this trade, or, I'm going to, a common one is I'm making money. And if I get out, I'm not going to make more money, but I want to give back money. Like you can sort through the fears and basically pick the action that aligns with the prediction that you're most comfortable with. But everyone's been told that you have to do it 100%, probabilistically. Like, first of all, I thought it's the future. So guess what? Like, no one actually knows, right? Like anything can happen tomorrow that changes whatever analysis you did. That's what happens every day, all the time, right? And particularly happens with Trump as president, whether you like him or don't like him, he tends to just like have a new idea and change what he's doing on any given day. And you get so things change. Well, like, you can have all the perfect analysis of how prices moved in the past. It doesn't have much to do with the probabilities tomorrow if, someone persuades the president that whatever, copper should be not controlled or controlled, whatever. Like you haven't. But the bottom line is how one feels, senses, feelings, emotions, intuition. It's a data set. Your brain is using it whether you like it or not. So like everybody has patterns of things they do that they don't want to do, right? Like, why did I do that again? The answer is in the prediction you were making. And that's going to be delivered to you in a feeling. So you want to stop like doing something or do something better. The more you become conscious of the real data set that's causing you to choose actions, the chances you choose the actions that get you more you want improve.
Before we close out today's podcast, how do you see the future of behavioral finance evolving? Do you think that emotions will ever be seen as a legitimate data source?
Yes. However, I think this is different than behavioral finance. Like the problem with behavioral finance
Hmm.
is Daniel Kahneman, one of the fathers of, was a cognitive behavioral psychologist, meaning you think and then you do, you think and then you behave. Now, if you look at Thinking Fast and Slow carefully near the end, he says, and I'm no better at this than I ever was. The model's wrong. We don't think and behave. We feel and behave. Hence, Descartes' error. I feel, therefore I am. Damasio, not me. I'm just the conduit. I literally am just a conduit. I didn't come up with any of this on my own, except for observing how well it worked. The guy jumping up and down was making the most money. When I started talking about this 21 or 2 years ago, whatever it's been now, basically people started coming up to me going, I knew it. I knew it. I just couldn't tell anybody. And now I have all these hedge fund clients who say, like I have a big well-known hedge fund, a client and his analyst a few weeks ago, they sat down, they did one of my core, what do you want, think, fear, and they decided they both were clear about what they felt, and they made 30% one day. And they said it was 100% due to analyzing their emotions.
Wow. Wow.
I'm just a conduit. It's just what the science says, actually. But the people don't hear the science because it's too threatening, it's scary. And I do have clients who are very well-meaning, but they've spent their entire life being in their head. And it's really hard to teach them to listen to what they feel. Really hard. Even when they really, I have one I'm going to talk to you later today, really, really wants to. He's just been in his head his whole life. So, but you can do it. I think if you want to and you're willing and you practice and you're honest about what you're afraid of in doing it, it's actually a more natural state to be in. It's not don't ever use your intellect. It's use your intellect for the things that are intellect based. Yes, you have to have an intellect to understand what the valuation of a stock might be. You're not, that's something you learn that you then can do, right?
Right.
But understand the reciprocal nature, and at the end, what feeling does it give you about what the stock's going to do over the time frame that matters to you?
Awesome. Well, Denise, I can't thank you enough for your time and sharing your wisdom and expertise with us today.
You're welcome.
Thank you. And thank you to all the viewers and listeners for tuning in to the NAGOMI podcast.